Hello everyone, and welcome back to the channel where we demystify the markets. Today, we're diving deep into fascinating microcap stock that has popped up on our hard-to-borrow screen. Wearable Devices Limited, trading under the ticker WLDS. This company is on the cutting edge of technology, developing a non-invasive neural input interface that allows you to control digital devices, like smartwatches and consumer electronics, using subtle touchless finger movements, especially through their modular development kits. It's an intriguing space, but we're here to talk about the mechanics behind its recent appearance on our radar. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. WLDS is a technology and consumer electronics company with a current market capitalization of just $6.06 million. As a microcap, it naturally comes with higher volatility and different risk profiles than larger, more established companies. Looking at the recent price action, WLDS has been on quite a ride. Today, it's up a modest 1.75%. However, over the last 5 days, it's down 18.99%, but zoom out to the last 30 days, and WLDS has seen an impressive gain of 81.25%. Here chart 30-day price action with 5-day overlay. Currently, today's volume is quite low at 139,701 shares, especially compared to its 30-day average volume of 2.70 million shares. This means the relative volume today is 0x its average, indicating significantly lower trading activity than usual. Why is cost to borrow and why it matters? So, what does it mean for a stock like WLDS to be hard to borrow? When traders want to bet against a stock, they typically short sell it. This involves borrowing shares, selling them, and hoping to buy them back later at a lower price to return to the lender, profiting from the difference. But borrowing shares isn't free. There's a fee, known as the cost to borrow, or CTB. This fee is paid to the broker who locates and lends you the shares. When a stock becomes hard to borrow, it means there's a scarcity of shares available for short sellers to borrow, driving this fee significantly higher. The fee is usually expressed as an annualized percentage, and yes, it can easily exceed 100%, sometimes even soaring into the hundreds or thousands of percent annually. For short sellers, these high fees eat into potential profits and add substantial risk. Why this stock is hard to borrow right now? WLDS has caught our attention precisely because of its incredibly high cost to borrow fee, currently sitting at a staggering 787.3% annualized. Highlight CTB-FE. This is a massive number and a clear signal that demand to short WLDS is high, while the supply of shares available to borrow is likely very constrained. Our internal data currently shows that the number of shares available to borrow for WLDS is unknown, suggesting extreme difficulty in locating shares. With an estimated float of only 1.9 million shares, even a relatively small number of short positions can quickly make the available supply for borrowing very tight. A composite squeeze score for WLDS, which considers CTB, borrower supply, float, and other factors, stands at 48.7 out of 100. This suggests a notable, but not extreme, potential for squeeze mechanics to play out. Squeeze mechanics explained. A short squeeze occurs when the price of a heavily shorted stock begins to rise significantly. This price increase can trigger a chain reaction. Short sellers, facing mounting losses and increasing cost to borrow fees, are forced to buy back shares to close their positions. This buying pressure further pushes the stock price up, causing even more short sellers to cover, creating a rapid acceleration in price. It's a feedback loop driven by short sellers scrambling to exit their positions. For WLDS, with such a high CTB and a relatively small float, any positive catalyst or significant buying pressure could potentially ignite such a scenario. However, it's crucial to remember that a high cost to borrow doesn't guarantee a squeeze. It can also mean that short sellers have strong conviction and are willing to pay those high fees to stay short. Dilution risk check. When we evaluate a potential short squeeze candidate, we always check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This typically lowers the value of existing shares and can completely offset or negate a short squeeze thesis, even when cost to borrow is high, by providing more shares for short sellers to borrow or buy. For WLDS, we found no recent diluted SEC filings such as -1s, -3s, or 424BS in the last 90 days. This is generally a positive sign, as it indicates the company isn't currently adding significant new supply to the market through direct offerings. Recent reverse split watch. Another important factor for WLDS is its recent reverse stock split. WLDS executed a 1-4-3 reverse split on June 22, 2026, which was 56 days ago. A reverse split reduces the number of outstanding shares, which can effectively reduce the float, and it resets the share price higher. For microcap stocks like WLDS, we've historically observed a pattern where many tend to see renewed volatility or even a price pop within about a month after a reverse split. While this is a common tendency seen in some microcap names, it's a pattern, not a guarantee, and WLDS is now just outside the typical 1-month window. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For WLDS, the critical things to watch would be any significant increase in trading volume, especially on green days, and further tightening of borrowable shares. A catalyst related to their innovative non-invasive neural interface technology or news regarding their modular development kits could also be a trigger. Given the current Xerox relative volume, any sudden increase in buying interest would be a notable shift. Keep an eye on the cost to borrow fee as well. If it continues to climb, it further squeezes existing short positions. WLDS presents an interesting case study in the world of hard-to-borrow stocks, driven by its high cost to borrow and relatively small float. While the 787.3% CTB certainly grabs attention, always remember that high fees alone don't guarantee a short squeeze. It's a complex interplay of many factors. Do your own thorough research into Wearable Devices Limited and its underlying technology, and understand the risks inherent in microcap stocks. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth market analyses, and let us know in the comments below what other stocks you'd like us to investigate. We appreciate your support.